fund criterion and investing, I want to talk about the concept that you should follow when answering the question, what next, you should think about what is the most fun or the most entertaining outcome, and then follow that one. That is, it sounds a little bit maybe pedestrian here, but this is actually very important moral guidepost because it follows a certain philosophy that basically says, look, as long as you're entertained, that's a good thing for you. And I want to talk about this a little bit in the context of investing, because I also want to question the sort of Bayesian approach of investing, or the idea that we attach probabilities to outcomes in investment processes, because I think it's wrong. And the reason it's wrong is because investing is the business of allocating capital to projects with human creativity. And in that context, probability is not useful. In fact, it's even detrimental. It is blinding your view. It's literally having a compass that follows completely different criteria than the ones that you actually want to follow as a wealth creating investor. Now, I'm going to define a little bit what that means, but this episode, I'm going to talk about probability, the lack of usefulness of probability in the wealth creation process, which is the business that Orange Capital Partners is in. And I want to also differentiate that to other people that call themselves investors. This is a Not Even Wrong podcast. It's August 26, 2021. This is Krim Delco. For the day, the fund is up 2.7%. Since the last update, we're up 40 basis points. We are now up 9.7% for the year. The market is up 19.4%. We're underperforming by 9.7%. So let me first start with the concept of Bayesianism and probabilities in the wealth creation process. Actually, before I even go there, let me define what I mean with wealth creation process versus investing. So the world of investing has a lot of different problems to solve. Unfortunately, it's all grouped under one word, which is investing, but these are very different problems to solve. So for example, people that manage pension fund money solve the problem of allocating capital according to certain regulated criteria. So on the one hand, pensioners can get a certain amount of money when they retire, but also the pension fund system is being used by the government to allocate capital to assets that the government wants that capital be allocated. In other words, it's a way to regulate capital flows. In particular, in the U.S., it's being regulated in such a way that capital flows into government bonds and mortgage-backed securities because that's what the government wants. So in that context, this is not wealth creation. This is let's call it savings management or something like that, but certainly not wealth creation. So we're not in that business, and that's not what I'm talking about. Then there are other types of businesses, let's say what we call typically, let's say mutual fund or fund management. Those businesses are, they're businesses in a sense that they do have the mission to try to create alpha, which means to be unique and make more higher returns than any kind of regulated return would give them, or anything like that. However, they're also not in the wealth creation business for investors. They're in the wealth creation business for themselves. In other words, they're what we call asset gatherers. So they are in the business of, I would say, they're more of a marketing and media business where they sell the illusion of having, being in good hands and all those kinds of things. So a bit like the insurance business, where you're trying to market yourself as a business that takes care of people, when in fact all you're interested in is collecting premium and then not paying out when accidents happen and things like that. So in that sense, fund managers are also mostly interested in gathering assets to collect premiums, or in that case commissions and things like that, and less in actually generating wealth. So we're not in that business either. We're not in the asset gathering business. We're not in the regulated pension fund business. What we are is wealth creators in a true sense, that our mission is to generate wealth by investing in fundamentally new concepts and engineering practices with a large impact. So we look for disruptive technologies that have the potential to make the world a better place according to our own objective criteria. And in that sense, we are looking for creative businesses. And now I want to go from here to the concept of Bayesianism and why in this particular business that Orange Capital Partners is in, Bayesianism just doesn't work. And I'm leaning heavily here on Brad Hall and David Deutsch, who talk about sort of the malfunction of Bayesianism when it comes to creative solutions. So in other words, what is Bayesianism? Bayesianism in a nutshell is sort of the idea that we look at the world all the time and then we just sort of say, okay, what's the most likely outcome in the next iteration? So let's say we look at the world every day or every minute or every year, doesn't matter what the clock rate is. The point is, every time we look at the world and we make a decision of what to do next, we just sort of gather the probabilities, we collect knowledge, and then we make a decision, okay, given the knowledge right now, the probability of outcome A is higher than B, so I'm going to go with A, etc. So this is kind of an idea that propagates also on Wall Street. Let's say many analysts talk like that. The most likely outcome is this, and the probability is that, and probability weighted stock prices, and all that kind of stuff. And I've been using these things myself as a employee on Wall Street, and then also as a fund manager, because that's what I was taught also in business school. Even though I went to Chicago, which is a very unique and very, I would say, organic business school with a very clear thought process and a value system that is much different than sort of the conventional wisdom in economics and on Wall Street. Even there, I was taught about things like probabilities and things like that. And I always felt that when I was actually a practitioner, particularly when we went on our own with Orange Capital Partners, so when I was really free to do what I thought was the right thing to do, I just always felt like probabilities are the wrong way to assess investments. And I didn't, I also had problems with that. Like, probabilities never helped me make money, that's for sure. They gave me the illusion of control. They also gave me a tool to, let's say, market myself to investors and all these kinds of things. But they never really, I just felt deep intrinsically, they never helped me make money. So to use an analogy, let's say in martial arts, jiu-jitsu, for example, probability would be a technique that just never helps you tap somebody and also doesn't really help you protect yourself from being tapped. But you're still using it because everybody else is using it. So it would be that kind of application that just doesn't work. And I think reading David Deutsch and listening to Brad Hall actually gave the explanation, because what they're saying is that, you see, in creative processes, when creativity is involved, probability just doesn't help. It's not very helpful. It's in fact wrong to use it. Now, what are creative processes? Creative processes are processes where there's potential, where there's counterfactuals, where there is, this goes back to Chiara Marletto and the science of Ken and Kant, where you're looking at information, you're looking at processes where there is information, where there is the potential for a switch to be either on and off, and there's the potential for humans making decision A or decision B, and so on and so forth. If you think along those lines, if you're in a business like that, you just don't have the probabilities are not helpful, period. Why are they not helpful? Because they, by definition, if you use probabilities rigorously, you're kind of looking at some sort of time series analysis. You're looking at something which looks back and then says, okay, look, having all the information from the past, this is the most likely outcome. And this is exactly why probabilities fail, because the information from the past simply is not very helpful when you deal with creative solutions. For example, if I look at the probability that a certain entrepreneur will create a new car company in the early 2000s that uses batteries and autopilot technology, that probability just has to be zero, because there is no, or almost zero, because there is just nothing, absolutely nothing in the past that gives me any kind of assurance that this project will succeed. So using probability in that case is futile. And every process, every business we invest in at Orange Capital Partners, in fact, I would go as far as say that we only invest in businesses where Bayesianism and probabilities are useless. That's a criteria for choosing an investment. If we can use probabilities, then that is not a good investment for us. Doesn't mean it's a bad investment for others, but it's not a good investment for us. So it's the exact opposite of what I would say a bulk of people on Wall Street are doing, which is if we use probability, then we are not interested in this kind of investment. And this also explains why it is ridiculous for us to, for example, compare our business with poker or any kind of game of chance. Because as Brett Hall says, in the game of chance, probability makes sense. So reading cards, playing poker, all that kind of stuff, yes, you can actually use probability. And you can be a very well-versed computer, or in other words, experienced player who can, with experience, so with a lot of data from the past, collect data and create Bayesianism, and on Bayesian foundations make decisions. That's fine, but that's not what we do. Again, we are not in that business. There are certain hedge fund managers who pride themselves of being poker players. They are, as far as I'm concerned, in the asset gathering business because they probably instinctively know that playing poker has nothing to do with wealth creation. However, they use it as a marketing tool to attract investment money. So again, I would say it's almost a manifesto worth statement that if there is Bayesianism to be applied to any kind of investment, then that is not for us. In other words, we only look at investments where Bayesianism and probabilities don't make sense because we are looking for creative processes that by definition cannot be assessed through probabilities. Now, of course, this begets the question, so what is it then? What are the criteria you can use? How can you make decisions? What are the decisions that you think you can use, or what is the information, or how should you even look at these things? So that's kind of, in a nutshell, of course, that is the complicated problem. And the answer that we have is we have a principle stack. We look at particular like principles that we derive from books, the 4 books, 0 to 1, The Beginning of Infinity, The Innovation Stack, and Innovator's Dilemma. Those are the bases. Those are the bases. We are also incorporating computation, like I said in one of the previous episodes, where we think that, okay, once we get through the principle stack and a situation, a business, an entrepreneur, or a project, or whatever we invest in fits into a principle stack, then we want to look at computation. We want to say, okay, is there a problem that can be solved with computation, as far as computation in a self-learning AlphaGo zero type way, where we can use data and run processes in a self-supervised reinforcement learning kind of context, where there is a lot of learning involved, learning as defined as try and error. So in a nutshell, what we're looking for is situations where there are new concepts, and therefore we can try to instantiate those concepts into engineering practices by try and error. And if the cost of try and error is low enough and we can iterate fast, we have a chance to then hopefully come up with engineering practices or products and services that can disrupt certain existing businesses or create new markets. And if those markets are large enough, then those are interesting businesses for us. So this is a very short version to explain what we look for. There's no probabilities involved here. There is certainly guesswork involved, like with creativity, because creativity is potential. And if you have potential, you are by definition sort of, I wouldn't say condemned to the world of guessing, but you just have to admit that there are certain things you can't potentially know, and you can't also quantify, in the sense that you can't just say, well, this is 14 times more likely than this. You can't do that. What you can do is you can say, well, given all the information that I have, as far as is this a unique situation, 0 to 1? Is there an innovation stack being built around a certain concept, innovation stack Jim McKelvey? Is this a situation where we are looking at a disruptive process a la Clayton Christensen, and then the beginning of infinity, which is kind of almost the principle of the principle stack, the underlying principle that tells us that everything that can happen will happen, and then we hopefully are just in the right multiverse that this has happened. Of course, this sounds a little bit too esoteric. What I'm trying to say here is that we are incredibly open and optimistic about the potential outcomes of things. We don't let ourselves be by any means constrained by the past. And then we look at, okay, how much computation can be used, because we want to be invested in companies that have the ability to use computation in an iterative way to solve problems that hopefully have large impact. So once all these things are given, then we invest, and that's it. We don't have probabilities attached. We can't say the outcome is more likely or less likely. What we can say, of course, is we're more comfortable with the actual application than maybe if we did something else. And now this leads me to the last point I want to make, which is the fun criteria, which kind of says, this is also something Elon Musk has said, it's the most entertaining outcome is the most likely outcome. Now, what does that mean? Okay, this has, of course, a sort of a double-edged sword here. On the one hand, it sounds kind of, okay, you just do the most entertaining outcome is usually something along the lines of violence and porn or something like that. I mean, it seems that we humans are drawn towards violence and porn, martial arts and sexy ladies or whatever. And of course, that would be a very narrow way to look at entertainment. And certainly a lot of people are entertained by a lot of other things. And this is also David Deutsch saying, look, solving problems in the end makes you happy. So if you have the ability to solve a problem, that is what entertainment actually is. Now, I think I have to do a little bit more work on this, or thinking, because I don't know what exactly David Deutsch means with solving problems. I'm reading a novel currently called Circles. It's a beautiful novel. I love it. I'm entertained by it. And why am I entertained by it? Because I think it's a good story. I think it makes me think. It inspires me. It gives me, I guess, maybe that's what Deutsch means with entertainment. It helps me think, and therefore I start solving problems, and that's interesting and inspiring, and so on and so forth. So maybe that's kind of what he means. But getting back to the point of what the most fun project, I think there's a couple of things I can say. First and foremost, a project is fun if I think it can be done. If you make me do something where I just absolutely know it's not going to happen, it just doesn't sound like fun. A project is fun when you have a situation where maybe you have energy. So I think the concept of energy and fun are very tightly related. Again, I'm not quite sure how. I have to think about this a little bit more deeply, but I feel like the concept of fun and energy, so meaning fun is a place where you don't need to apply as much energy as maybe another place where there's less fun. So fun and energy are related, and you can get outcomes with less energy. For example, if my son is playing in a soccer team right now, and he has a situation where there are people around him that are negative and frustrated and things like that, and it takes a lot of energy to be part of that team, and that is not a fun situation. So in that sense, I think if you're part of a team that has energy, is exciting, then that's also the more likely outcome, meaning this situation will survive. So we can look at it from an evolutionary perspective, simply that fun projects are projects that can get something done with less energy than maybe other projects, and therefore they have a bigger chance of survival. And the question then is, of course, in Silicon Valley, you often hear, well, we want to solve hard problems. So we could then argue, well, why don't we just solve easy problems? They use less energy. I think it's an optimization problem where we want to solve the hardest possible problem with sort of the least amount of energy. So we want to optimize that. Certain problems are very easy to solve. They also require very little energy, but they're not as fun to solve as those where they're very hard to solve, and we can still apply enough energy, or we have the energy to solve them. In other words, we have concepts and engineering practices that can get us from not knowing how to solve the problems to solving the problems. So to summarize, I think the fun concept to me has an evolutionary aspect, and it's just sort of, I see it as an energy application question, or in other words, how difficult is the problem I can solve? Difficult in a sense, first of all, is it impactful? Does it have things like impact? That's an important one. But also, is it a situation where I can solve the problem with, I mean, I have a chance to solve it, and also I have the resources to solve it. And that's, I think, where these fun tensions happen. And that's when we get excited as investors or entrepreneurs, when we look at a problem, for example, the self-drive problem that Tesla is trying to solve. And we were kind of looking at full self-drive, version 3 and 4 and 5 and 9, and it just started getting a bit cumbersome. And now we're very excited because we feel that an AlphaGo Zero type application, or an AlphaGo Zero type way to solve the problem, which is self-play and those along those lines, we just believe that can have much better outcomes as far as self-driving is concerned, and that creates fun again, because we have a big problem to solve, which is take the human out of transportation. We were feeling that there's a lot of energy required to solve that problem, and now we have all of a sudden a new route to solve the problem, which requires less energy. It's still a lot of energy, but it's a little bit less, and the chances to success is also higher, and therefore it's more fun. So this I would say, take CRISPR. Why are we so excited about CRISPR? Because solving, let's say, pharmaceutical problems such as cancer and things like that, medical problems, is incredibly difficult. But once we have a way to digitize our genetics and rewrite them, and then use that technology to use computation to solve problems, it becomes solvable. We can solve much bigger problems with still a lot of energy involved, but it's doable. We have the resources, we have the knowledge, and we can build innovation stacks around them. And that goes back to the criteria of iteration. We can use iteration, build innovation stack, low cost of iteration, which helps us succeed on building the innovation stack. So this is the way we see it, and we believe that Bayesian approaches are not just not useful for our purposes, it is a criteria for not to invest. If you tell me that a certain project allows Bayesian reasoning, then I'm not interested in it. And there's anecdotal evidence for that in Silicon Valley. For example, investors like Khosla, they said, if you give me an ROI, I'm not interested. This is just an anecdotal way to say the same thing, which is, if I can do a Bayesian approach, if I can use probabilities to assess a project, I'm just not interested. This is what it actually means. And again, instead of probabilities, instead of using this type of approach, we have to use something else. And the reason we have to use something else is because we're talking about creative processes with potential, and therefore with situations that don't have any past and therefore cannot be analyzed using probabilities that are derived from data points from the past. Thank you.